Right, the next thing I'm going to talk about is individual health insurance. This is probably one of the most misunderstood health insurance products, if you will, in the country. First of all, most people say, well, if I buy group insurance, don't I get a discount? No, you actually get charged more. Individual health insurance from now until 2014, and this will change after 2014 once the mandate dials in, but from now until 2014 is 35 to 40% less than group. 35 to 40% less than group. We still have adverse selection, meaning it goes through medical underwriting. You can be declined, you can be rated, or you can be ritered. So we still have an adverse selection process, but if you qualify for it, and there are many companies out there offering many plans, you could save 35 to 40% depending. So that kind of gives you some idea of part of the myth. And I'm going to give you an example here of a school teacher that came into my office a couple of months ago. He was an Olathe school teacher. He was 35 years old and he was paying $940 a month on the Olathe School District plan. He was the teacher. His wife and 2 children were on the plan. He didn't cost anything. That was paid for by the school district. He was paying $940 a month for the coverage for his wife and 2 children. And I met with somebody here last night who had a similar situation where that occurred. And I had a caller last week who called me from Tuscadero, California, whose husband was a correctional officer, and she had the same situation where she was paying this huge premium for her and her child even though her husband was covered. So the solution was, let's look at going to an individual health insurance plan. Well, he looked at Affordable along with a whole host of other plans and decided that's what he wanted to do. So he went from $940 a month to $246 a month, and I thought he was going to pass out in my office when he saw he was going to save $8,328. That's a lot of money for a school teacher. That's a lot of money for anybody. So he was quite surprised. How did the plans match up? Well, he didn't have unlimited doctor visits, although he felt that his family was very healthy. He had 5 visits per child and 5 visits for his wife. He had all of his wellness benefits covered. He had all of his generic drugs covered. He had all of his urgent care covered with a copay, no deductible for any of that stuff. But look how much money he saved by doing this. $8,328. This is huge. You know, the other problem that I see, and I had a lady talk with me about this last night right here, are folks that are getting ready for retirement. Maybe the husband is close to 65 and the spouse is 62 or 61 and the husband wants to retire, but if he retires, how is she going to get health insurance? Well, you don't wait until it's time to retire. And this is the biggest trap that retirees, or those of us that are chronologically challenged, find ourselves in. And that is, how do you buy health insurance to bridge the gap to get you to Medicare? And what you have to do is you plan to get off of those plans as quickly as you can if you're going to retire, and get that individual health insurance policy for that spouse so that that spouse can go to 65 and then control their own destiny and make it to Medicare. What you don't want to do, and what a lot of people do unfortunately, is they stay on COBRA. And COBRA runs for 18 months. And then what winds up happening is, now I'm 62 and a half or 63, and I'm on COBRA. Oh, I developed diabetes while I was on COBRA. Oh, I developed asthma. I have high blood pressure, cholesterol, whatever the case. I had a minor stroke, or I had a heart issue. Maybe I had to have a bypass or a stent put in. All right, well, guess what? Now you're not going to qualify for health insurance. You're going to wind up on the state pool, and it's going to cost you $800 or $900 a month. Control your own destiny. Get off of the COBRA. It's not a big, warm, fuzzy blanket. It's a false sense of security that in 18 months is gone. And if you don't have coverage in place to carry you past that, and you're a retiree, you're going to fall into that gap, and then you're not going to have coverage, or you're going to pay a huge amount of money to get it. So COBRA is not a warm, fuzzy blanket, and we really urge people to get off of it as quickly as they can. The other problem with COBRA is it's very expensive. You're paying your portion, plus you're paying the employer's portion. Imagine, you know, back to the Olathe school teacher, what he would be paying if he was paying his own plus his wife and children, probably around $1,200 to $1,400 a month. So that gives you some idea of why COBRA is not something you necessarily want to do. HSAs on the individual side, anybody that's 50 and above, 55, husband and wife, $1,000 deductible versus $5,000 on the HSA. The cost savings on these kind of policies will typically fund your health savings account. So a husband and wife can put $6,800 in a health savings account. If the difference in premium pays for it, that money's yours. This isn't a use it or lose it like a flex plan or cafeteria plan. It's your money. So you put $6,800 in it that you saved in premiums for a year. The money belongs to you and you use 1,000 of it and there's $5,800 left. That rolls over to the next year. It's yours. You can put another $6,800 in there. That money going in is tax deductible like an IRA or 401k contribution. So now you save the money, you put it in your account. Oh, by the way, you're getting a tax deduction. That's not a bad deal. That's a really good deal. That's your money. You got a tax deduction for putting it in there, and when you take it out to buy health care of any kind, including if you buy glasses, if you go to the dentist, anything that you do with that money, see a doctor, whatever the case may be, you can pay for it out of your HSA account and it's tax-free. So HSAs are a wonderful program and they make a lot of sense and they do a lot of good. We even, on occasion, when someone really wants to look at a way to trim down the cost of their health insurance, go back to that 35-year-old, sometimes we'll take the husband and the wife and put them on the HSA and buy a fully insured plan for the children. Because we know the kids are going to go to the doctor, they're going to get the flu, they're going to have a problem, they're going to sprain an ankle, they're going to do something. So we'll put them on a child-only policy. It may cost $70 or $80 or $90 a month, and put the parents over on the HSA. That reduces premium, and it allows them at the same time to put money in that HSA account. And by the way, even though it's the parents' HSA, they can pay their children's copays, deductibles, and anything else out of that HSA account. So HSAs are very popular. They've increased by 30% in the last year. They're hugely popular because they drive down cost and they do what I talked about in the first segment. That is, they make you better consumers of healthcare, because once again, the money's coming out of your account when you decide, do I want the X-ray, do I want the MRI, can I get a generic drug, or should I buy a name brand drug? So the choices lie with you. You're now the consumer of healthcare, and that's how this works. So HSAs are very popular, and they work really well. A couple of things I tell people about individual health insurance: don't buy it online. You ever call up eHealth with a claims problem? Know what you get? The number to the health insurance company. There's nobody there to help you. Go to an in-house salesperson at a health insurance company, same thing. You got a claims problem, you've got an issue, they give you the number to customer service. Buy it from an independent broker, an independent agent who is going to go out and shop the market, get you medically underwritten quotes, and when there's a problem, that broker or agent needs to be there. I'll tell you a little story. We had a client not so long ago who passed away. He was on a group health insurance plan with a company called Starmark. He had moved to Cobra and died 2 days later. He had a $17,000 death benefit coming, and Starmark said, we're not going to pay that. We said, you might want to think about that again. And so we sent them a letter, and we advised them that we expected them to pay that death benefit. They paid that $17,000 death benefit because we made it very clear if they didn't, we would then go to the Department of Insurance and file a complaint. That's not something they wanted us to do. So they paid the $17,000 death benefit. We got a beautiful letter from the family telling us that we had no idea how much money that meant to the family, because how much that money meant to the family, because they had a lot of medical bills, they had a lot of issues, and they needed that money desperately. That is what a broker and an agent is supposed to do. I take calls from people all over the country that call me. We're not their broker, we're not their agent, but they call with claims issues, they call with issues they can't get resolved. There's a process for that. You have to know how to use the process. That's the job of the broker. We tell our clients, don't call the insurance company. Please don't call them. Because by the time you call them and sit on hold for 20 minutes and get 5 voice prompts, you're going to be so angry by the time you call me, I'm not going to want to talk to you. Call me first. Tell me what your problem is. Let us get on the phone to the carrier and say, hey, you didn't pay this claim. You made a mistake. You need to get this paid. Or, here's one that I really enjoy. I had a lady call me a couple of years ago, and she was very upset because the insurance company didn't pay her anesthesiologist when she had knee surgery. So I went out and I sat down with her, and she gave me the bills, and I said, wait a minute, you've got 2 anesthesiology bills. Well, she said, yeah, I got billed for one for this knee and one for the other knee. But you only went to sleep 1 time. Right. We went back to the doctor's office and said, you owe her $5,000. and if you don't pay it, we're going to file a complaint with the Board of Equalization and the Licensing Board for Physicians in the state of Missouri. They paid the $5,000. I'm not sure that was the first time that had happened with that particular anesthesiologist. My point is, again, that's the broker and the agent's responsibility. That's what they are there to do for you. So if you buy off of eHealth Insurance, what happens? There's nobody there to help you. Number two, the other thing that eHealth Insurance and online services do is they like to pick the easy cases. They don't want those cases that have got medical problems. They don't want to deal with those. So you fill out that electronic application and get declined. And what's the first question on the next app you go to fill out? Have you ever been declined for health insurance? Well, you have now. So between now and 2014, when this all changes, it makes a lot more sense to use a broker, use an agent that's going to be able to tell you whether you're going to qualify for that coverage, what are the medical underwriting conditions for that company, how is it going to work. That's what you need to do, and that's why we recommend, and Dave Ramsey, who's on 400 radio stations, says use an independent broker or agent when you buy health insurance. That's what makes the most sense.